Hi everybody, and welcome along to the new year, and welcome to the Mint monthly update for the single sector funds. It's David Fyfe here, the portfolio manager for the New Zealand mandates, giving an update on December and how the year finished up. So I thought I'd start with a couple of pitches around, I guess, what worked in 25 and what didn't, and a couple of different parts to it here. I mean, we're thinking about the Trans-Tasman funds. Like closer to home in New Zealand, one of the key drivers for the outperformance was probably a bit more of a cyclical and defensive skew, unlike what we hear in the US, where it's all sort of the growth in AI names. But back in this part of the world, a lot of the drivers were around a recovery in real estate over the year, which was certainly driven by the falling rate environment. And similarly in utilities, partly the rate environment, but also a recovery in good weather for the gentailers, which has certainly helped. And additionally, a couple of other areas where New Zealand has sort of been slower has been both tech and healthcare. And I guess that relates to what we're seeing in Australia. We look to the right there on those the red circle around the underperforming sectors in the ASX 200 was certainly seen in the tech and healthcare. And again, that did accelerate into the year end as we saw the expectation for rates to remain higher, or if anything, start to hike. And certainly some of that's priced in locally here now. So yes, we did see a big swing in what worked and what didn't. But again, health and tech suffered sort of broadly as well. Also fears around AI bubble has certainly continued to weigh on certain stocks and sectors. But what did work, I guess locally here, we certainly saw in the consumer staples sector, a lot of the agri names actually had a great year, whether it was Scales through to Fonterra, but very much A2 was one of the big larger caps that did drive a great outcome up well into the double digits towards 60% plus for the year. In Australia, it was a similar story with some of the industrials over there being reasonably strong and solid performers. But what really drove the market in Australia last year was really around resources, both the strong gold price, but also the recovery in iron ore. So we certainly saw some mixed fortunes in the year of 25. But just rolling through to the funds themselves, the NZX 50 was up fractionally for the month, reasonably quiet month, December, it often is. Most companies had all their results or updates out earlier. In terms of how we tracked itself, a couple more charts there showing the skew of what made up 25 in New Zealand context. Top picture there, we chart from Forsyth Bar, just showing the difference between value and growth over the year, and it really was a value year. Some of those were in the cyclical names, but again, it was certainly partly the fortunes of the growth were certainly underwhelming, whether it was through Fish and Paykel Healthcare, even some you might call growth in Evertool names, but in Mainfreight, etc. But there was certainly quite a divergence of returns across the board. And in terms of December itself, there's a couple of big swings really. One of the most notables was Gentrack, down over 20% of the month. Again, it had been a stock that performed very well, so coming off recent highs. But additionally, it was around fears of competition, largely Kraken, its big global competitor that's now into the New Zealand market, providing software to Meridian. And they did a big, large capital raise, certainly a large valuation, but also a well-funded competitor. So certainly expecting a bit more competition in that space. Serco was one of the better performers for the fund. Probably not a lot to call out in that space other than it had been under pressure and bounced back, but probably on relatively low liquidity. And other names that did well in the month was Fletcher Building, a lot of offshore interest as the expectation of a New Zealand recovery sort of started to sit across names like Fletcher's after it has been already in other names, and domestic cyclicals like Freightways. Again, we will see how Fletcher's perform as we sort of see how the consents roll out early in January, sort of a quieter period for that market, but one to keep an eye on. And Somerset was another one that probably struggled a little bit in December. We are sort of seeing a lot of interest in Ryman leading into their Investor Day late January. So it is one that we're keeping a close eye on and will certainly be of interest. But in general, it's a bit of expectation around what sort of earnings guidance they can provide. From Ryman as a name that's probably less seen as the growth year of the sector, which is generally that title given to Somerset, but one that we are keeping an eye across the board for the New Zealand there. In terms of the Australasian fund, some similar performance there through a strong Serco and a weak Gentrack supporting the fund. One of the names that's been a bit of a challenge over the month, again, was Telex. A couple of different features there driving that. One, of course, is the pending lawsuits and outcomes that are sitting in front of the name that have certainly spurred a bit of negativity in the stock. While we see the fundamentals for the business strong, the shorts in the name have ticked up, so that's certainly had downward pressure on the stock. But in terms of some key milestones, in terms of clinical milestones for the products like 591 that sit within the radio pharmaceuticals that within Telix, there's nothing that's changed there majorly at the moment. Some small delays, but in general, we see that as a story with large amounts of upside and continue to hold the story there. And other names, again, Challenger to perform nicely for the fund. And just in terms of what has driven Aussie, we talked before around a couple of areas, but in the last quarter, I thought I'd put this chart up here from CLSA, looking where earnings have gone in the last quarter of the year. And unsurprisingly, similar to the performance of the sectors, you can actually see that tech and healthcare have suffered, partly to do with a few stock specifics, but in general as well, we've sort of seen a bit of a downgrading of growth across the wider Aussie universe. Additionally, we've seen that resource uptick as well as gold and iron ore continues to tick along nicely there. But in terms of names in the fund, we continue to own a bit more Napier Port in terms of the core port infrastructures sector that continues to perform well. And similarly in SRG, as we touched on before, has continued to do well with the fund, as it has a lot of infrastructure and different projects going on from there. And lastly, leaning into the property fund, property has had a phenomenal year. I mean, the chart on the right there is showing the total returns across the key property names. And as you can see, more than half of them sitting well into the double digits, both from a yield and a capital outcome for the year. So it has been a strong year, unsurprisingly, with what interest rates have done. To be honest, it did finish on a negative. As you see, the benchmark was down over 1% for the month, and that's reflecting what we've seen in the long bond moves, which has lifted over almost 50 basis points in the last period. So it has been a more challenging one. One of the names that we continue to like and has done particularly well in the last month has been Goodman Group out of Australia. We did see a large announcement from them around a big data center contract. It's effectively repurposing a lot of their freight or logistics sites around the world, ready to go, power connected, and they've signed a very large pipeline of work across Australia, the US, and Europe, which is continuing to be accretive value to the business. But also, it's been an area of focus, as it has been in a lot of stocks with AI and what it truly means. Additionally, we saw the completion of the internalisation of VHP and Vital, and as we see rolling to New Year, that's the name that's continued to perform well post its capital raise, and one we'll continue to keep an eye on. Additionally, in terms of the NZX property market, now has a gross yield at sort of 7.5% now, so it continues to be somewhat attractive. As well, it's continuing to do well, and we think will continue for the year. In terms of within the fund, we have trimmed out Charter Hall, which is a name in Australia that's done particularly well over the last quarter, so we've reduced that back and continue to add a bit of Kiwi property into the fund. So that's a whirlwind summary of what was the December month. Very quiet overall, but one that continue to do well. And for, as I said, as per normal, if you have any questions or want to reach out to us at Mint, feel free to reach out to us at info@mintasset.co.nz, and we look forward to updating you on the year ahead and our outlook on 26. Thanks very much.